These last few weeks, we've been writing a lot about what is going to happen in 2022. People are very worried about supply shortages. They're very worried about inflation. They're worried about the ability for the economy to sustain growth.
Wage compensation has accelerated. But if you think about what's happened to inflation, that's not what this has been about in the past 2 years. It's been about goods prices. Services ex energy risen 2.9% over the past year. They could go up some. Goods prices jumped 7.3%.
We're looking out a year and asking ourselves, will wages continue to go up at unusual rates? And our answer is no. Will goods prices continue to go up at a 7% rate? The answer is definitely no. We could actually imagine a situation at the end of next year, and you can remember that we're saying this, where there could be a glut of certain things available to you.
So this is starting to dissect the story as to why the Federal Reserve is not reacting as if inflation is going to be 5% forever.
We're coming in for a landing, meaning that we are decelerating, we're coming down to a normal flight level, and we're putting ourselves on a plane that is going to be different than it has been for the last 2 years. Now there are some tailwinds, which is this excess demand, the ability to need to fill supply pipelines, but also on the other hand, some headwinds, which is China's unusually slow growth after a period of pretty extraordinary growth that took us all the way through 2019. What we are going to see is a continuation of certain trends that are truly unstoppable that we've talked about. And one of them has to do with e-commerce. And one of them has to do, frankly, with work from home behaviors. These things are going to be permanent changes. And so all of these things are the ones that we're trying to weigh and measure in coming up with our plans for next year, and why we think there'll be a slightly higher ambient rate of inflation, but not a continued rate of inflation that would become of great concern.
We want to talk a little bit about some of the victims on the supply front and how we might actually think about exploiting that in the coming year. Staples this year underperformed by 16 percentage points behind the S&P 500 on those soaring costs. What happens next is the key question. What happens when you get a slower growth rate? We shift in relative performance. We have routinely shifted over the coming 12 months to more defensive sectors outperforming the cyclicals. We're going to carve out 10% of portfolios for domestic and international dividend growth stocks. And if we take a look at those that have had the most routine, consistent dividend growth, it's been that poorly performing staples sector.
So what we're talking about is potentially a 7 to 8% growth in earnings per share for US and global corporations. Now, if we hadn't come off with a 45% year, everyone would be thinking that was pretty good. But because we've had such an extraordinary recovery, as you'll see in the data, it doesn't feel that good.
When we think of the last couple of years where we had deficit financed fiscal stimulus of 13 percentage points of GDP, we knew this year that the economy couldn't grow that much. It's above our speed limit for inflation. We're looking now at a moderation in growth, a moderation in inflation, and a year ahead that's completely different from both 2020 and 2021.